Okay, after we found our book value cost of 12,250, we want to find what our net cash flow from our salvage value is. Okay, the problem tells us that we're going to have an estimated market value of 15,000. So this comes from our fixed inputs up here. It's 15,000 right here, 15,000, and then our book value is just what we found. Our book value, you just bring it down here. Okay, expected gain or loss, we just subtract our market value from our book value. So we're going to have a gain of 2,750. Okay, we're going to have to pay taxes on that gain, so we multiply this 2,750 times our tax rate, which would be this I-22 right here, 40%. To give us, we have to pay taxes of 1,100. So we have a net cash flow from our salvage value of 13,900. We just take our 15,000, subtract our 1,100 to get 13,900. That's what we get to add to our cash flow at the end of the year, or at the end of this project for the 3 years. So now we want to set up our timeline here of our annual cash flow. So you need to have each one of your years here, 0 through 3. Okay, at time 0, we're going to have an equipment cost of 170,000 and our net increase in working capital of 20,000, and we get that by saying our increase current assets, subtract our current liabilities, our increase in our current liabilities. So that gives us our increase in our net working capital. Okay, now you just bring your units sold. This is, you see how we just bring those down from the fixed input column of 115,000 into each one. Okay, and our sales price comes from our fixed input column. Now, our sales revenue is found by units sold multiplied by our sales price. So that gives us our sales revenue, and we do that for each one. Our variable cost is our units sold times our variable cost per unit, which is $1.95. That's how we get our variable cost. Our fixed operating cost is a given, 70,000, comes from our fixed inputs. Our depreciation comes from our depreciation schedule, which we've got right here. So our first year is 57,000, our second year is 78,750, and our third year is 26,250. Our operating income before taxes is our sales revenue, subtract our variable cost, subtract our fixed cost, and subtract our depreciation. Okay, that gives us our operating income before taxes. We have our taxes. We just take our taxes, we take our operating income times, and this will be our tax rate that we have up here in our fixed input data. And you do that for each year. Our after-tax operating profit would subtract our operating income before taxes, subtract our taxes to get our earnings before taxes. Okay, now we add back our depreciation because it's a non-cash expense. It's really a fictitious expense. It didn't cost us anything. So we add it back, and then we sum our after-tax operating costs and our depreciation to get our operating cash flow. Okay, and so then we find our net cash flow in this line. That would be our sum of this column, our net cash flow would be this sum and this sum. Now, you'll notice here we have to return our net working capital of our 20,000. Okay, in year 3, we have our after-tax salvage value, which came from this column right here, or this input right here, our after-tax salvage value, because we're going to get to sell our equipment back. And so we have a total of those are totaled up, and our sum would be this plus this other cash flow here, our total termination cash flows. So now we have our net cash flows. Now we're ready to find our net present value, internal rate of return, and modified internal rate